Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, February the 27th. My name is Eric Wilkinson, and some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we are here to teach you some different strategies that you can then implement into your portfolios, but please do that in your own way. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with economic data. Today's a pretty good day for economic data and pretty surprising, actually, on quite a few of these data points. But let's start out with across the pond. Basically, we got a couple of bond auctions out of Italy and Germany. That, for the most part, was the only thing we really saw across the pond that could make any type of movement. It didn't really give it a reaction. They all came in line with expectations or what has been previously done throughout those auctions. Then we move back here to the United States, where we've got all kinds of good data. We got final wholesale inventories. Remember, we talked about this. Inventories building isn't a bad thing if you expect to have that moving later on, all right? In and around, let's say, a holiday season, coming up to Christmas or something like that. But we're heading into the summer where there's not a major buying trend type of event going to go on. And what we're seeing here with these wholesale inventories, they were expected to rise by 0.4%. They rose by 1.1%. That's pretty dramatic. These inventories need to be moved in order for companies to make money, right? And or they're building it for future expectations. This just seems a little high for future expectations of selling that stuff. So anyway, moving on to other information. We got Powell speaking again today. Factory orders came in at 0.1%, expected to be 1.5%. That's part of the problem, right? Factory orders, maybe these guys were expecting more orders, being that 1.5, that big miss caused those inventories to rise, okay? So going forward, those are two key components to look at. Missing on the sales number, over expecting on the build, on the expected demand, if you will. So if a lot of these companies, these factories are doing too much building, you could start to see some write-downs going on later on in the year, which is going to hurt their earnings per share and stuff like that. So earnings going forward for some of these manufacturers could start waning a little bit. All right. Then what else we got? We got pending home sales. Pending home sales, remember we talked about with the building permits and stuff like that. Pending home sales has not been very good, to be quite honest. But they came out and knocked it out of the park this month. Came in at 4.6%, expected to be 0.7%. This is one of those numbers that I've been looking at for a while now and wondering what's going on, where the interest rates rising starting to cause these people to kind of sit on the bench, if you will, and not really buying. Well, it seems like it was the last several months on these readings. We've gotten negative readings, and all of a sudden this pent up demand came through with this huge number beating by quite a lot. One of the biggest beats I've seen probably in a year at least, or so maybe. That was a huge beat on that number anyway. Then I think that's about it. Do we have... I think that was the last one I wanted to talk about. Oh, no. There's one other one I want to talk about. Oh my gosh, crude oil inventories, a drawdown of 8.6 million barrels, expected to be a build of 2.8 million barrels. So that is about an 11 million barrel miss. All right. What do we see in crude oil? We don't have crude oil up right now, but crude oil should be really starting to rally. And now that whole theory of me thinking it's going to go back down to the mid to lower 50s is kind of out the window now. I'm actually leaning more towards the 60 handle if we're starting to see this kind of demand. I mean, that's just a massive beat on demand for crude oil. So we could easily see that 60 handle coming up. That's all we got for the economic data. Some good stuff coming out later on today. We've got Japanese industrial production and Chinese manufacturing purchasing managers index later on tonight. A couple of those numbers, I mean, obviously China always cheats on their numbers, but they've been pretty good indicators recently because they haven't been able to fudge them too much. So keep your eyes out for those. Crude oil moving higher by about $1.80. Like I said, I could easily see this peeling into the 20s later this, maybe early next week, let's call it. All right, gold futures still losing their luster. They're off a little bit, looking like they're going to go back down into that 12 handle, which is where I've kind of expected them to be. VIX is moving a little bit higher today. We've got a bit of a mixed bag that we'll talk about here. I mean, at any given time in the equities, at least in the mini S&Ps, they were in positive and negative territory from the start. But Dow Jones Industrial Average down over 100 points, 150 points-ish. We've got the NASDAQ starting to accelerate some of their losses right now, down about 35 points. And then on to the mini S&Ps. They were the ones that were kind of bucking this trend. Now, a lot of this has to do with, I've started adding some negative deltas because of yesterday and the last 2 days market setup. We got a bit of this top and what's looking to be a confirmation. This could be creating a bottom. Again, strength into the close is going to be bullish. Weakness into the close going to be very bearish. This is very touch and go at these levels, if you will. All right, E-mini S&Ps on the 30-minute candle. Each candle is 30 minutes, and each blue section is a day. So you can see on the economic data, some of those data points were not very good. The crude oil inventories number, probably the one that's really starting to push this, because if there's demand for crude oil, it means the economy is doing rather well, and the consumer isn't afraid of this extra tax with the gasoline and stuff like that. So that could drive demand for crude oil, which will overall give an indication as the economy is doing rather well. So we're getting a bit of a rebound on the crude oil inventories number. Now the bonds coming off quite dramatically today, as you can see. You know, we've talked about this. The bonds, with the way the economic data points are coming out, the FOMC, and we're hearing from a lot of these Fed governors, not going to be raising rates in 2019. All right. A couple of things that I was looking at earlier this morning before the markets opened, and this is that topping pattern that I was talking about. Basically, we got a big rally, topping pattern, break below the 200-day moving average with a big sell-off yesterday to the lows, weakness into the close there in the rut, which is the Russell 2000 index here. Getting a little bit of a bottom here, but again, really important to see the rest of the day how the market reacts to some of these economic data points that we got today. I'm kind of leaning towards the bearish side for the most part. And it's not necessarily because of those economic data points. It just seems like the market wants to pinch people right now. And the pinch would be people expecting this market to rally, and then when it obviously starts selling off. And again, I was going to pull up IWM. I don't know what happened to that chart, but it looked almost exactly like the rut. If we look here, again, that topping pattern sell off today, finding a little bit of a support, but I would expect it to kind of continue a little bit anyway. I'm not expecting a big downturn to test these lows that we saw back in December, January area, but I do expect it to kind of at least get a little bit of a correction here just to shake out some of the weak hands there. All right, CSCO is a trade that I added, some negative deltas. This parabolic move just seems a little overdone, to be quite honest. So I thought with it being extended this far, it seems like the volume is starting to wane at these levels. That means that the price is not being accepted by the retailers or anybody else for that matter. So we would expect this to start rolling over. So with that being said, I did it as a small tranche as well. I did the May, bought the 50 puts in there for $1.56. Right off the open, bought those in, and looking for a bit of a correction, like I said, and then I'll look to get out of those. Those are real tight to the market, so I'm not expecting a major correction, just a little bit tiny move, maybe back to where we consolidated down and around here. So that would help out quite nicely. That's all I've done. I haven't taken anything off right now. I am keeping an eye on that deer, but it's kind of sitting pretty right now, so I'm going to kind of hold on to that a little bit longer. It's not quite to that 30% of max profit that I was very close to a couple of days ago. So I'm going to kind of hold off and let this play out a little bit longer. That's all I got. Check out the webinar we're going to be doing tomorrow. It's on the broken wing call butterfly. It's kind of similar to what we did with the ratio put spreads. This one, though, will be able to be put into an IRA. All right, it is IRA appropriate because it is a defined risk strategy. I'll show you how to set this strategy up in that webinar, go through all my rules as the environment and everything else, strike levels that we need for us to increase our probabilities of success. All right, so that's all I got for you till tomorrow. And if you can't take that, take it easy.